Credit score is extremely important when it comes down to getting financing from a bank. As far as having a minimum credit score, I've had a client get approved for a decent rate with a 580 credit score. And it's because that client did not ever make a late payment on any of their debt. It was just that they had a small collection of medical debt and they're almost maxed out on their credit card. So technically there is a minimum. I mean, anything under 600 may be challenging to a bank to get you that mortgage. But as long as you don't have a lot of late payments and you have a credit history, you should be okay. Now, if you have a lower credit score, then your interest rate is going to go higher. Because remember, it is all risk-based. So somebody with, let's say, a great credit score is going to get the best interest rates. Somebody with a lower credit score, they're going to get a higher interest rate because that money is much more expensive to come. And remember, banks have underwriters that review the risk of the file. So if they're looking at your credit score, not only do they look at your credit score, they're looking at the content of your credit. Why is it bad? Why is it low? Is it because there's no history? They're looking at the entire picture. And my suggestion is to always check your credit and have those apps so you know the algorithm of your credit score before you start having that pre-approval done or applying for a mortgage. In my opinion, if the buyer doesn't really like the rate they're being offered from the lender they're talking to, I think it's very wise for them to start shopping out and talking to 3-4 local mortgage people, right? Because I think mortgage folks will try to do their best to give the buyer the best rate. But sometimes it's not in their ability because remember, most mortgage folks work for large institutions. So it's hard to negotiate rates. A lot of banks will do a float down. So if you lock in a rate today, let's say at 3%, and prior to closing rates drop, they may have the ability to float the rate down if it drops. So in the beginning of the process, talk to your mortgage person and ask if they do float downs on their mortgages. And most banks, especially in the New York City area, they will float the rate down if it's dropped before the closing. So if you don't like the rate that you closed with, I think refinancing is a great strategy to lower your rate if you weren't happy with it. Because remember, you do not incur the same closing costs on a refinance as you did when you first purchased a home. You don't have to pay the mortgage tax, the transfer tax, and the mansion tax. So if rates have dropped after you purchased your home, it is a great idea to refinance because the cost involved could be astronomical.